Hope you are all doing very well, are healthy and are safe, and a very, very good evening to you all. It is said that knowledge is like money. To be of value, it must circulate. And in circulating, it increases in quantity and hopefully in value. It is with that guiding principle that I welcome you all to the first of our webinar series of World of Financial Reporting. You may have thought, what is World of Financial Reporting? Uh, what is it that we exactly do as part of World of Financial Reporting? Let me tell you this: we had an idea, we had a thought, and the thought was, why should costs come in the way of high quality financial reporting and learning solutions? Uh, why is it that these cannot come, or the quality of a large firm cannot be received by recipients at a reasonable cost? That's when we thought this idea that we have the skills and we have the knowledge. Uh, Costs we did not want to come in the way of knowledge. And that's why we are here in front of you today, World of Financial Reporting. What do we aim to do as part of this is, we would like to be a platform that shares knowledge. As practitioners, we will exchange information with you. We will share periodic reminders with you on financial reporting. A lot of items keep coming up. The world of regulatory reporting, financial reporting is dynamic. There are changes that keep coming about periodically. We bring those changes to you, and we also try and bring information to you and our short analysis on them. Follow us on LinkedIn, follow us on YouTube. You will find some of these changes as they are announced. That's not just it. We would also like to be a platform where we have webinars like this more frequently and exchange knowledge on contemporary topics. And finally, we are accessible on the go. Just feel free to reach out, to call any of us. You have our details, and it will be a pleasure to interact with you and exchange ideas. So with that background, the only thing that I'll say is save the date. What we are planning to do next as part of this knowledge sharing platform is, in the month of October, we will have another webinar like this one on Ind AS 116 and the LIBOR reforms. Some of these items don't just have an accounting impact, but they also have a business impact. And that's why we'll try and talk about them to you right now, so that you don't deal with it when it becomes too late to deal with it. In November, we talk about CARO 2020. This is going to be a key change, both for auditees as well as the auditors. The requirements under CARO have increased manifold. It's not something that can start in April and we signed off in a couple of days. Gone are the days of CARO when we were so used to the clauses that we could start work a week in advance and then conclude it before the audit committee. This one is different. There is data to be obtained. There are a lot of scope for controls to be enhanced that the auditors may want to look at. We'll talk a bit about some of those in the webinar in November. December is the month which is generally a holiday month, festive season, but more importantly, it's the end of Q3. Like we are having this call today, we will have a call with you in December to talk you through the updates or the reminders for Q3. Finally, year end is a big time. The financial statements, the size of the financial statements just multiplies. It goes into 100, 200 pages for many of you. So we'll probably end up having two of these sessions or discussions. One is, once again, reminders which are relevant from the year end. And more importantly, a lot of us don't tend to place adequate importance on is the disclosures that are required in the year end financial statements. So we will talk to you about the disclosures that are required in the year end financial statements. Without too much ado, without spending too much more time on the background, we will straight away jump into some of the key financial reporting reminders. If at any stage you have questions, please feel free to put them in the chat box. The method that we are planning to adopt is, I'll take you through all the updates. And at the end, we will keep the house open for question and answers. For those of you who are not yet introduced, my name is Pratik. I have been a part of a leading accounting firm, both in the audit and the advisory function. And I'm a co-founder of the World of Financial Reporting. So here we are, without spending too much time, let's straight away head into the key updates for the quarter. One of the first, the item that we are going to pick up right at the beginning is something that impacts all companies, irrespective of which sector you are in. This is, in my mind, one of the most important update for the quarter. Given the pandemic situation that has arisen, many companies have seen impact on their business of the pandemic. It could be in the form of slowdown in business, lack of business, impact on supply chain, the customer demand going down, and a whole host of them. But one must remember that they have an obligation to settle in terms of lease payments. Against this backdrop, many entities have gone back to the lessors, asking them to modify lease arrangements, to defer lease payments, and in some cases even ask for a waiver of the lease payments during the pandemic period. Now, if I had to just take a step back, the accounting for any of these changes under Ind AS 116 would have required modification accounting to have got triggered. What the modification of a lease requires in a normal accounting standard requirement is it requires the lessor or the lessee to recalculate the present value of the lease rentals that they will pay using the current discount rate, which poses a lot of practical challenges and hardship for preparers. The first one is the fact that you have to negotiate and deal with the business situation itself. And second, in the current environment, it's also very hard to get a reasonable and a fair discount rate to apply. Given this kind of a hardship, a lease modification amendment was introduced. This, friends, is a practical expedient, meaning it is optional upon companies as to whether they want to apply it or not. It is not mandated for companies that they have to apply this. How does this work? The gating question is the rent concession a direct consequence of COVID-19? And this is an area where some amount of judgment is required. This could be, like we commonly say, a facts and circumstances based assessment. But it's not so complex. A few key points that are available as guidance or that one should keep in mind as a guiding principle. The first one, try and understand the reason as to why the negotiation took place in the first place or took place in the first instance. If the negotiation took place in the first instance because of the impact of COVID, then that's a good indicator of the fact that yes, the concession is a consequence of COVID. Alternatively, look at the documentation. A lot of times we keep saying the devil is in the detail. Look at the detailed documentation. Find out what is written in the contract as to the reason for the negotiation. A lot of times that provides us good enough evidence as to why or how something is related to COVID. Finally, if there are multiple concessions that are being negotiated, very important to try and once again tie them up together, triangulate all of them together and see if they really relate to a financial reporting or relate to COVID. Once you have crossed this gating question, and in the current scenario, it is more likely that the concession would be an impact of COVID-19. Once you have crossed that hurdle, then that's the point where you are eligible to apply this expedient, but it's an accounting policy choice. Now, if an entity does not want to apply this, the lessee will go back and apply the guidance contained in the standard on modification of leases. That's right. You take all the leases, take the present value of those leases by discounting them at today's rate. It may be cumbersome, but that's the requirement. Alternatively, if a lessee has decided to apply this expedient, then the application is to apply the practical expedient, and we will cover what the accounting aspects of the expedient are. But all is not yet done. Even having concluded that yes, there is an intent of applying the expedient, there are three cornerstones or three keystones or points that one should satisfy or comply with before the expedient is available. Let's take a look at those with the help of examples. You can see them at the bottom of the screen here. The first one is that the revised consideration should be substantially the same as what it was immediately prior to the change. Again, involves some element of judgment, but not so judgmental. This is slightly more quantitative in nature when it comes to the assessment. The second one is extremely objective, very difficult to get. a subjective assessment in this. The reduction in payments is only for those payments that are originally and contractually due on or before 30th June 2021. Now, one could ask why 2021, why 30th June? The answer is there had to be an end date. And if you look at the guidance that is there, it states that it could not have been left open perennially. It could not have been infinite. The standard setters in their wisdom thought 30th June 2021 should be the date. So if the contract puts out any leasing payments up to 30th June 2021, and that is getting modified or amended, then it's eligible in order to avail the practical expedient. The third condition, and this is where there is slightly more element of judgment, is that the change should not be a substantive change to the term of the lease. If it's a substantive change to the terms of the lease, that is when the expedient does not become available. So after the gating question, you have three conditions to be satisfied cumulatively. It's A and B and C. Once you've gone through all of them, that's the time you apply the expedient. You would have noticed throughout our discussion that we've had in the last few minutes, I have constantly used the term the lessee should do this, the lessee should do that. And that's because this entire amendment is only applicable to a lessee, not to a lessor. I'll talk a bit more about these three boxes here on the subsequent slide with a quick example. The first condition, we said that the revised consideration should be substantially same as that immediately prior to the change. All right, now let's quickly read what is there in terms of an example. Let's take an example to assess this better. A retailer leases a large shop in a mall at a monthly rental of 10 lakh. As a result of COVID-19, this is evidenced by fewer footfalls. The retailer agrees with the lessor to defer the rent for the period April to June 2020. However, the rent for Jan 2021 increases to 11 lakhs to compensate the lessee for time value of money. The key question is, if this is the nature of the modification, would it be eligible to say that the consideration is substantially the same? Now, the way the standard setters have interpreted substantially same is that this has to be assessed generally in present value terms. And therefore, the moment somebody is compensating for time value of money, this condition is deemed to be met. So in our example, everything else being met, this kind of a clause would permit a user or a lessee to avail of the exemption. The second condition that we spoke of was reduction in payments should only pertain to those payments that were contractually due on or before 30th June 21. Another example, let's take the same lessee, the retail shop. The rent from the period June 2020 to December 2020 is the subject matter of the deferral. It will be paid out in July 2021 to December 2020. Now, remember this expedient talks about payment should be originally due before 30 June 2021. Now, therefore, the lease rental that is getting deferred is eligible because that date is before 30 June 2021. It does not matter if the eventual payout actually happens after June 21. That's a subtle nuance to be kept in mind when concluding on this point. As a contrasting example, let us say the lessee said, please reduce 40% of all my rentals starting from October 2020 to October 2021. Now in this case, the condition would not be satisfied because if you look at the last 3 months, which is October 21, that falls outside the window that is given in the standard, in which case a lessee will not be able to avail. You could have a question as to can the lessee break this arrangement down and say 40% of rentals till 30 June 2021 and the balance of them are outside the practical expedient. The answer to that situation fact pattern is that it is not permissible under the standard. Finally, let's take an example to look at substantive changes to terms and conditions. Now, a lessee has granted a rent concession where there is a 3-month deferral of rentals and eventually the lease term is increased by 3 months. Now, friends, this is an element where there is some bit of subjectivity and judgment. It is judgmental because at the end of the day, what is substantive, what is relevant, or is a substantial change or not is about judgment. Now, in this case, given that it is because of COVID, given that the rent for 3 months is deferred and the term is extended only by 3 months at the same amount of rent, management can conclude that this is not a substantive change to the leasing agreement. Therefore, given the three conditions, one would be able to meet the practical expedient if all the other conditions are satisfied. Right? So three conditions, cumulative conditions, all of them need to be met. And what is the accounting treatment? Let's just look at that on the next slide. As we said, no change for accounting for lessors. A lessor cannot take the benefit of this expedient. If it's a modification for the lessor, so be it, it's a modification for the lessor. Now let's look at a real life situation and see that if I was a lessee, what type of negotiation could I end up doing? One is I could request the lessor to waive the rent entirely, which is the box over here. Or I could say, look, I can't pay you now. Why don't you allow me to pay this later, which is the third option here. In the second option, the standard has stated that where there is a waiver of a rent or a forgiveness of the rent or a complete absolvement of the liability to pay rent, that is the time you treat this as a variable rent under Ind AS 116. The way to account a variable rent under Ind AS 116 is that it impacts P&L in the respective period. Now today I have a lease liability, but I don't have to pay it. And therefore, if it's a variable rent, I simply debit my liability and credit P&L. The accounting for ROU remains unchanged. Friends, a common question could crop up is, if I have a deferral, should I suspend the amortization of ROU? Once again, the guidance states that the amortization of ROU should continue as it is because the right to use the asset is continuing. What is only changing is a payment term. On the other hand, with respect to a deferral of a rent, there could be two possible scenarios. The first possible scenario requires a debit to the lease liability and a credit to P&L, but this will be calculated by discounting the new cash flows at the new discount rate. Or alternatively, do nothing to the existing lease arrangements and account for the deferred rent payments as and when they are incurred. And we'll hope to pick up some of these examples in the webinar that we hold probably early October to take you through some of these to practically implement. The idea of this session is only to try and highlight to you the key changes that have happened. All the changes are at times fairly nuanced and take up some time to create and discuss. In the interest of time, right now, the only placeholder that should be there in your mind is that an alternative accounting treatment exists. And finally, let's not forget the cash flow statement, a very critical element of the entire piece of financial statements. If there is a rent concession that adjusts or that results into an adjustment of a lease liability like this one, please do not forget to consider this as a non-cash change in the cash flow statements. That could at times get missed out, and we could just normally assume this to be adjusted or netted off against the payments that are being made. But we must bring this out if material it's a non-cash change in the item. Once again, the principles of materiality override many other things. So therefore, if it's a material amount, please do disclose this as non-cash.